$12.49. Let's check out the summary to see how much has been consolidated. Today we're going to be discussing 5 things you should know about your student loans, specifically your federal student loans. First, you should understand the types of loans you have or the ones that you're applying for, along with their interest and fees. The best way to visualize this is to break it down into 3 different categories. There's loan type, borrower type, and interest rates. One of the different loan types are subsidized loans, which are available to undergraduate students with financial need. These loans don't accrue interest that the student is required to pay back under certain terms. They also have relatively low interest rates. Unsubsidized loans are granted to undergraduate and graduate professional students at a higher interest rate. Then there's Direct Plus loans that include the previous types of borrowers as well as parents. Now each one of these has different levels of interest rates, all of which are fixed interest rates, so long as they're federal loans. Now obviously, the less loans you take out, the lower overall debt you'll have. But you really want to avoid taking out the Direct Plus loans, not just because they have the highest interest rates, but they also have the highest fees. Which brings me to my next point. Federal student loans have fees associated with them. This means that the money that you receive is actually less than the amount that you borrowed, and you're still responsible to pay the full amount back. The way that this is illustrated, let's say that you borrow $10,000 at the current fee amount for Grad Plus loans, which is 4.284%. You'll actually receive only $9,575 and some change for tuition, books, and living expenses. And you're still on the hook for $10,000 plus interest. Apparently, this fee goes to whoever's servicing your loan, which is generally one of these companies. Second, understanding your repayment plan and how it's structured. There are a number of repayment plans which fall under standard repayment plans, forgiveness programs, and income-driven repayment plans. Each one of these repayment plans have a variable repayment period ranging from 10 to 30 years, and with each one of those has its advantage and disadvantage. I've spoken about the forgiveness programs in another video, which I've linked in the description down below. But let's go ahead and look at an example of a standard 10-year repayment plan versus the income-driven repayment plans. A student and his family recently graduated from undergrad with $37,000 in student loans and landed a job making a little over $50,000 per year. Under the standard 10-year repayment plan, our recent graduate's monthly payments will be $405. Realizing that the payments were too high, he opted for the income-based repayment plan and is now paying $248 per month, which is more manageable for him, but in the long run, he'll end up paying more. Here's a chart that breaks down some of the other repayment plans. Again, there's advantages and disadvantages for any one of these plans. Third, just because you're making payments doesn't mean you're paying off your loans. So let's return to our recent graduate and say that he took out $32,000 in unsubsidized loans, and by the time that he graduated, the interest brought the total amount to $37,000. Let's say that he's on the 10-year standard repayment plan, making $405 payments per month. After making 18 monthly payments, he decided to look at the status of his loans, only to be surprised by the fact that he still owes $32,000 in principal. Unlike a mortgage or other debts, where a payment applies to the interest and the principal, student loan payments apply only to the interest first. Federal student loans are calculated by daily simple interest, which means the loan's outstanding balance grows every day rather than being compounded on a monthly basis. So a principal amount of $32,000 at 5.7% earns $5 per day in interest. So if the first $405 payment reduces the total amount to $36,595, then the next payment made is 30 days later, the new total then becomes $36,340. Again, this is because it's earning that $5 of interest per day. In that example, the individual will eventually pay off their student loans. However, there are some repayment plans where the monthly payments are lower than the amount of monthly interest that's accruing on the loan. And at this point, you really can't even consider it a repayment plan. In fact, they actually have a word for this. It's called negative amortization. Fourth, avoid loan capitalization. Capitalization is the addition of unpaid interest to the principal balance of a loan. Essentially, if you have a principal amount of $10,000 with $1,000 in interest, if this was capitalized, the principal amount will then become $11,000, increasing how much the loan is accruing in interest each month. There are a number of ways that interest can be capitalized. 1. At the end of a grace period for unsubsidized loans. 2. Failing to recertify for your income-driven repayment plan. 3. voluntarily leaving an income-driven repayment plan or no longer qualifying for certain income-driven repayment plans, which you should take into consideration when filling out your annual renewal form. I've noticed that there's a little box that says, check this box for lower payments, and in quotations, recommended. However, if I qualified for a lower payment because of a family size change or a financial situation, essentially that would voluntarily move me out of my current payment plan into another, ultimately capitalizing my interest. 4. Following periods of deferment on an unsubsidized loan and or forbearance on any types of loans. So I had a patient tell me the other day that every year around the holiday season that they put their student loans into deferment. Now, depending on the type of loans that they have, when they come out of deferment, the interest would be then capitalized. Which made me wonder, I wonder what would happen to my loans if I did that every year for the rest of my 20-year repayment plan. A little bit here, $12.49. Let's check out the summary to see how much has been consolidated. Oh. 5th, save money. Most, if not all, federal student loan servicers will allow you to set up an auto pay, which in most cases will reduce your interest by 0.25%, which doesn't sound like a whole lot, but over 10 to 20 years, that can save you hundreds, if not thousands of dollars. That's it. Thanks for watching, guys. I appreciate you watching my video. Don't forget to do the YouTube things, like, share, subscribe, comment, do all that good stuff. I hope to see you at the next video.